fundsupermart.com.
What is the outlook for emerging market debt over the next 2 to 3 years?
We like emerging market debt, and we think the various areas of emerging markets, whether it's local currency bonds or external currency bonds, they both hold a lot of favor for us, and we continue to see strong demand from all of our clients for assets that provide yield with some relative safety. And there's probably no better spot to earn that yield than in emerging markets. These are countries that are in much better shape than developed market countries. They continue to run healthy surpluses, and I think default losses will be quite minimal in emerging markets. So on top of that, you're actually getting better yields than you might get elsewhere in the globe. And I think with inflation also beginning to subside in many of these economies, some of the traditional drivers of higher rates are also disappearing. And so I think capital losses should be less of a concern. And so our view over the next 2 to 3 years will be that emerging market debt will emerge as a very high quality asset class that provides very generous yields. That combination, to me, is a very powerful one.
Can you tell us a bit more about the investment objective and strategy of the Threadneedle Emerging Market Debt Fund?
Yes, I mean that particular fund is designed to primarily access external currency emerging market bonds, so mostly dollar-denominated securities. It can be a range of investment grade and non-investment grade rated sovereigns, but it does focus on the sovereign debt of global emerging markets, and so it attempts to stay very diversified, earn a very good rate of interest, but also to add a lot of value through what I would call relative value picks. Being in the right countries, at the right time, it has been a significant source of value added, and I think that volatility will allow us to continue to add value, not just through the asset class, but through the active management of the fund.
Mexico and Russia are the only two countries with more than 10% weighting based on the fund's latest fact sheet. What are the reasons for this allocation?
Well, I think there's a few reasons. One, those happen to be quite large markets in the emerging market space, but they're also large markets that are relatively high quality, and so that combination, I think, is why we tend to hold some larger weights. Now, we wouldn't do that unless we also thought there was value in those regions, and in the case of both of those, we actually see significant value in both Mexico and Russia.
Is there any investment idea the fund is positive on right now?
Well, I think we're positive on a range of different countries. You mentioned Mexico and Russia, but I also think that when we see slowdowns, there's some positive news to a slowdown, and you'll recall that there was a lot of fear about some emerging markets actually growing too rapidly, and I think in countries like Brazil, for example, the slowdown has actually been a good thing, and so we're also quite overweight Brazilian bonds within the fund. And then we have a range of Asian investments as well, such as Malaysia and Indonesia, that we've actually been quite positive on. So again, the idea is to be diversified within the fund, and I think we see a lot of opportunities on a global basis. The one region that I think we've remained underweight and probably will continue to be underweight in is the Eastern European sector, again, highly sensitive to the Eurozone as a whole. And so I could see us going back into that space when the Eurozone crisis is a little bit clearer to us, but right now we're underweight that sector.